everyone. So in this video, I want to talk about dividend investing versus trading or capital gain investing or buying and holding long term or day trading. So the different types of strategies when it comes to trading on the stock market. So first, let's talk about dividend investing, the benefits of dividend investing. First of all, it is probably the most passive way of investing because all you would have to do is buy blue chip stocks or big name companies that pay a decent dividend per year. On average, it's usually you're going to get 4% per year just in dividends. Sometimes you can find stocks that pay 10%, but they'll be a little bit riskier. And they will usually be REITs, real estate investment trusts, or mutual funds. But the reason why I say it's the most passive way of investing is because you buy once, you wait till the stock drops, you buy, and then you just hold forever, and you just keep collecting dividends. And with the dividends that you're collecting, you buy more of the same stock or other stocks that pay dividends of about 4%. And eventually, your portfolio will grow fast, and you'll be making a decent income just from dividends. And all you were doing is simply buying stocks that pay dividends without having to worry when to buy them or when to sell them, because your plan is not to sell them. Your strategy is just to keep buying stocks that pay dividends so that eventually you're making a decent amount of dividends. For example, if you saw the video from Stefan in Project Life Mastery, he shows his 3.5 million portfolio and he shows how he makes about $8,000 a month just in dividends. So if that's what you want to have, or if that's where you want to be, then that would be a perfect strategy. Very passive, and without doing anything, you're generating $8,000 a month in revenue. But to get $8,000 a month, you need to have $3.5 million of a portfolio, which represents about $8,000 a month, represents about not even 3% per year in income. So that's why I don't think it's the best way of investing. I mean, there is no bad way. I mean, all the ways are good. There's probably just better ways or ways where you can make more money. But as long as you're profitable, I mean, all the ways are good. But the issue I have with dividend investing is that you're only making 4% a year on average, which is not a big number. It's great as a passive investment, but it's still not a huge number, 4%. You have to have a huge portfolio so that 4% of that represents something decent. Imagine with a 3.5 million portfolio, imagine if you're making 10% per year or 20% per year. So if you're making 10%, that's about $350,000 a year that you're making. So that income is better than dividend income, in my opinion. And the way you can make that 10% is with capital gain, by buying and selling. You could buy the same stocks that pay dividends, but buy them low and then sell them as soon as they go up a bit, for example, by 10%. And as long you can hold them as long as you have to until you reach that goal that you want. So you get that capital gain, but you also get that dividend at the same time because you've probably held it for more than 3 months. So by doing that with your portfolio, I like to call that capital gain investing. So by doing that with your portfolio, you're increasing your portfolio by more than 10% every year instead of just 4% a year. So when you were dividend investing, your portfolio was increasing by 4%, and when you were taking that 4% that you're receiving and buying more stocks that pay 4%, you're using compound interest. But the rate that you're using is 4%, so you're doing compound interest at 4%. Now imagine doing the same thing, but 10%. Your portfolio is going to grow much faster. So especially at the beginning, if you're starting off and you have a smart portfolio, dividend investing will probably take time for your portfolio to grow. But if you buy and sell, if you focus on growth investing, stocks that have potential to grow, and sell them, your portfolio is going to grow faster, and just keep repeating the process. And so you're compounding the gains, you're compounding the interest that way. And then when you have a big portfolio, let's say 100,000 or 200,000, keep making 10% by buying and selling. Obviously, you're not going to be buying with the full 100 or the full 200. You're going to probably break it up in like 10 chunks. But every trade you make 10% or more. Well, then the overall for the year could be 10% or more. So you're still the capital gain that you're generating will be your income, or a part of it could be your income, but it's still going to be bigger than the 4% that you're generating from dividends. So the only difference is By dividend investing, it's much more passive. You don't have to worry about it. It's less stressful, but you're only making 4% a year. By growth investing or capital gain investing, when you're looking for stocks, when you want to buy and sell stocks in a relatively short period, you still have to watch your stock almost every day, look for buying opportunities, keep an eye out on your stocks, to know when to sell. But in my opinion, that would be the best and probably relatively easiest way to grow your portfolio. I mean, it's not that time consuming at all. Personally, I look at my watch list every day for sure, but I only take action when I see something at an attractive price. I place my order, a limit order, so I let the system execute the order on its own. I'm not sitting in front of the computer when the order gets executed. And then when it does get executed, well, I decide if I want to sell it at 10%, I'll see what price that is. I'll place a sell order at that price so that it gives me 10%, and I just let the system execute automatically. I'll still watch my stocks every day, but there isn't much action that I do. So it's basically just watching. But I enjoy watching, so it doesn't feel like effort. It doesn't feel time consuming either. But it definitely feels good when you sell a stock at a profit. Because nothing, in my opinion, nothing's more frustrating than to buy a stock at $10, watch it go to $15, and then watch it drop back down to $9, and then later in the future goes back up to 15 again. I would be frustrated knowing that I missed out on profit initially, or confirming the profits initially. So my goal is, there's a difference between investing and trading. When you're investing in the company. You want to be part of the company. You trust the company. You want to participate in the ups and downs of the company. When you're an investor, you don't just take the positives and leave the negative. You're in it for the good and the bad when you're an investor. But when you're a trader, you basically just want to take advantage of the fluctuations of the stock. So you don't really care about the company. You don't really care about the well-being of the company. You just want to buy into the company when you think it's at a good price, and you want to sell out of the company when you think it's reached the highs that you think it could reach. So in that case, your company is your portfolio. So you care more about your portfolio than the company that you're investing in. You want your portfolio to grow. Your portfolio is your company. And the best way to grow your company is to take advantage of those fluctuations, to confirm your profit. But to watch your portfolio grow and then come back down again, and then grow and come back down again, and all you're doing is collecting dividends of 4% per year, I'm not sure that's the best way to grow your portfolio. It's a profitable way. It's less of a headache for sure. It's safer, but it takes time, and you need to have a large portfolio in order to feel like the 4% per year that you're collecting is worth something. So investing is when you really truly believe in the company and you want to be an investor. You want to be sort of like a partner in the company, and you're in it for the good and the bad. But a trader usually is in it short term, just takes advantage of the fluctuations in the price. So the best way to make money on the stock market is definitely day trading, but it's definitely the hardest and the most stressful way. Personally, I tried it in the past and I lost a lot of money, so I let it go for sure. It's not for everyone. Day trading is not for everyone. You need to have the type of personality that could endure stress and can watch your portfolio lose 5% in one day. Because the thing with day trading is you don't make profit every day. Some days you lose. But the idea is you want to have more winning days than losing days. But the days that you lose, will you be able to handle the loss, or will you try to do like a revenge trade to make up the loss that you made and then end up losing more? So it takes a lot of this discipline, a lot of focus, and I think it's not for everyone, definitely not for me. It would be very stressful, especially that you have to trade with a big amount, because you're usually making 1% to 2% gains per day. So if you're trading with $1,000, that's not going to get you much. So you need to trade with at least $10,000 per trade. So when you place a trade with $10,000, you accept that you might lose on it. You put a stop loss order on it so that you limit your losses. So let's say you buy a stock at 10, you could give it an order that as soon as it drops below 9.5, sell automatically. So if that happens, you just lost 5% on your $10,000. And then you have to wait the next day to look for another trade that hopefully is positive, but you're starting off with 9,500 instead of 10,000. You could have 3 bad days in a row, but hopefully you have more profitable days than you have losing days. Swing trading is the same thing as day trading, except that with day traders, they usually don't have any holdings at the end of the day. So they sell all their holdings before the stock market closes. So at the end of the day, they have cash, and they just the next day. So basically they're in and out of stocks while the market is open. They don't hold anything after hours. So it's good in the sense that it's very liquid. Your money is available to you. You get less exposure to the stock market because you're not holding it overnight, because sometimes you could hold the stock overnight, the next day it opens much lower. So you're sort of protected by that because you're in and out the same day. So now swing trading is the same thing as day trading, except that they could hold the stock for several days or even several weeks. But the idea is to buy low and sell high, but in a short period, and basically just taking advantage of the fluctuations, but really a short period, like a few days or a few weeks. And there's a lot of technical analysis that is done by reading the charts and certain indicators in the chart that helps them identify a resistance and the lowest point and a trend and patterns. So that's really day trading. And swing trading, I find, is probably the best way to make money, but not the easiest, and definitely the most stressful and the riskiest. So definitely not for beginners, in my opinion. I hear that some day traders make about 15% per month. So of course, that's much better than 4% a year or 10% a year. But of course, it's much riskier. So from my 10-year experience trading on the stock market, I realized it's important not to be greedy, just to be reasonable. And as long as I'm making, in my opinion, as long as I'm making 10% per year, which is above average returns here in Canada, it's very good. And as long as it's compounding every year, then my portfolio will grow fast. And then at some point when I have a big portfolio, then I could mix it up a bit. I could do a bit of dividend investing. I could do a bit of capital gain investing, and I could do a bit of, maybe if I have like $500,000 portfolio, I could do maybe $20,000 just day trading, just trying my luck again with day trading. So yeah, so out of all these strategies, I prefer capital gain investing, but I think I would consider myself more of a trader because I try to take advantage of the fluctuations. I don't really care about the companies that I'm investing in. I just basically want to buy low and sell high, but I'm willing to hold it for as long as I have to, from 3 months to 6 months, even a year. And I collect dividends all the time. Some stocks I'll keep forever because of their dividends. If a stock pays more than 10% per year, I'm going to keep it forever because my goal is to make 10% per year. So if I already have a stock that pays me that 10% per year, then I'm going to keep it. So I have New York Mortgage Trust that pays that, and I'm thinking of buying Dividend 15 Split Corp. I already have some Dividend 15 Split Corp 2. That one pays, right now it's paying 20%, but I know it's not gonna last. So yeah, my goal is to make between 10 and 20% per year, but most importantly is to compound it. So let's say I have $1,000, it turns into $1,100 at the end of the year. Take that $1,100, make 10% on the $1,100. So I'm not only making 10% on $1,000, I'm making 10% on the $100 of capital gain, and that way my portfolio will grow fast. And usually I'll make 10% probably in 3 months. In one trade, I'll do it in 3 months. But obviously, if I have a $30,000 portfolio, I don't put $30,000 in one stock. I'll break it up into. Right now, I'm doing $2,000 in a trade. So every time I make a 10% gain, it's only on $2,000. So hopefully, I can do it at least 15 times in a year, so that my whole portfolio is affected by 10%, and then just keep repeating the process. Hopefully. So that was my opinion on dividend investing versus capital gain investing versus day trading and swing trading. So if you have the personality for it, day trading is where you'll make the most money, but it's definitely the most stressful, the riskiest, and I would not recommend for beginners. Swing trading is a bit similar to day trading, just instead of selling your holdings before market closes, you can have positions for 2 or 3 days. Dividend investing is probably the safest and most passive way of investing, because all you have to do is buy big name companies that pay dividends of at least 4%. Just keep buying them, and then you'll just keep collecting 4% because you know these companies are not going to disappear. So you're always going to be getting your 4% per year, and you're compounding that 4%. So that's a great way of investing. Safest way also, very passive. Much better than the banks, of course. And you might be getting capital gain, but if you don't plan on selling your stock, then you're not really benefiting from the capital gain. You bought a stock at 10, it's now worth 15, but if you're not selling, it's just worth 15. You're not really benefiting from the capital gain. And in 20 years, it could be worth 20 or 30, or it could, depending on timing too, it could drop right in 20 years. The stock could crash and it could be worth 15. So you waited 20 years just to make 50%. General long term, the stock market does go up, depending on your time frame, depending on the timing. But when it comes the time for you to sell in the future, you might have just erased all your gains that you were sitting on for the past 20 years. So that's why I like to confirm my gains by selling, and then just looking for another opportunity, buy and sell. And if I have to hold longer than I expected, I'm collecting dividends. All right, thanks for watching. If you have any questions, leave them in the comments below. Any stock tips, leave them in the comments below. Also, your opinion is greatly appreciated on this matter. So also leave them in the comments below. Thanks.